Hi, friends, welcome. And I want us to take a quick look into audit of liabilities. Liabilities auditing can be difficult. Let me put it straightforward. Not that it is difficult to be conducted, but it is complex, and most people don't like complex stuff. Okay, so that's liabilities audit. That's what we are looking at today. Now, it is also one of the riskiest areas to audit. The reason is that, most organizations wouldn't like to disclose their liabilities. So you see them trying to conceal it. They want to hide their liabilities. So you find, and in fact, if they don't tell you, sometimes you struggle to even get it because they omit it totally from the records. You can't really find it. So there's been a number of scandals in the past, especially in the sector of financial services, the banking sector, where banks, organizations have collapsed because, or losses have been incurred by these sectors because they try to conceal or hide their liabilities from the view of auditors or from reviewers. So that's what I want us to look at. Before we proceed, in the year 2018, EY audited this particular private hospital operator. It is called NMC Health. NMC Health. It is actually based in the United Arab Emirates, Abu Dhabi. It has its headquarters in Abu Dhabi, Middle East. Now, it is this company, NMC Health, also owns within the UK. You may have heard of Aspen Healthcare chain in the UK. They own it. NMC Health owns this Aspen Healthcare. And in 2018, EY, the Financial Reporting Council, investigated EY because their audit of the 2018 financial statement of NMC was not done right. Because, there were things which were hidden from the auditors, or the auditors did not dig deeper to see what was actually happening there. And so the company actually collapsed, went into administration right at the pandemic, during the heat of the pandemic in 2020. Now, you know what happened? The company actually had hidden over $2.7 billion from the board. The board didn't even know that this kind of debt existed. 2.7 over more than $2.7 billion actually. So in fact, when it was later revealed in March 2020, they realized that their net debt had actually risen to about 6.6 billion. It was 3 times more than what was reported in the books. So it was because these guys hid it. They've hidden debt facilities, loans, and checks, and 3 times higher than what was actually reported. NMC also were investigated because they thought there was some fraudulent activities within the accounts, which the auditors did not disclose. And again, EY was also investigated because somehow the directors, okay, those who sit on the board of NMC included former EY partners. So there were some ethical considerations there, thinking that maybe EY did not do a good job because they know they had some kind of conflict of interest. They are former partners sitting on the board. So that was what happened. Anyway, so we move on to what we have. I'll make it straightforward and quick. We are not going to examine you on provisions and contingent liabilities and financial instruments, no, or leases. We just want to see how do we audit these items, okay? So like I said, it is an area that I have seen auditors, beginners, they are not comfortable auditing these areas. But the seasoned ones always love it because it's quite complex. It requires someone with a better understanding and appreciation of audit conventions, audit approach, evidence gathering, to be able to undertake the audit of liabilities. So we'll look at principles of auditing liabilities in the balance sheet or statement of financial position. We will not dwell so much on the difference between accrual and provision. You know it from your previous study in FA, in financial accounting, whether basic or intermediate, whether FA1 or FA2. We then look at audit of accounting estimates under ISA 540. Okay, again, we are not going to test you on ISA 540 accounting estimates. disclosures and provisions, okay? And then the problems of auditing contingent liabilities. This is typically where we would have looked at IAS 37, provisions, contingent liabilities, and contingent assets. But we will not dwell on the contingent aspects, okay? And discuss the procedures to be followed to ensure that all liabilities have been included in the SO statement of financial position. Remember the management assertions under this area. Gather the evidence. Are they completely included? Now, the main thing you would want to audit here is completeness, because they want to hide things from you. So check whether they've included everything. So typically what you would have thought of under liabilities are the payables. So the trade payables, the accruals, the provisions, we need to audit them. Okay, let's take one after the other, these items. So under trade payables, the company has bought stuff from people and they are yet to pay. Usually just like debtors account, like receivables account, you would always have a control account reconciliation automatically conducted by the client. Obtain that reconciliation and check the balances to the purchases ledger, to the nominal ledger, okay? And then supplier would have provided statements to the company, to the client that you are auditing, so that you want to check whether the supplier statements jives with the reconciliation conducted with the purchases ledger. Any invoices received, you must vouch them. Look for whether everything has been correctly stated or something is missing out. And of course, just like receivables, rarely in the past people do not do this, but recently we do it. So you pick out major suppliers and send them confirmation. It's like a debtor secularization, so that they will confirm those balances and perform cut-off procedures. So sometimes we have debts we have to pay as a company, or the company has a debt it has to pay, and they want to shift it to the next year so that they will reduce their debt portfolio this year. So check the cut-off procedures. Have they really included everything within this fiscal year, or they've cut off some and decided to post it to in the other period? Accruals. So here, consider the client's accrual system. Like I said, we are not looking at difference between provisions and accruals. You know it. We are not looking at that. We're looking at the auditing, okay, of accruals and provision. Now look at the client's systems on how they capture accruals, and what is the justification for accruing for those electricity, insurance, and then even payroll accruals. Check. What is the justification? It is always important to reperform calculations of accruals. Accruals, we can always recalculate it, and at the end of the day, you reverse any accrual which has been paid, okay? And as part of subsequent events, like I said, look out for cut-off procedures and check whether after year end, there are some invoices which relates to the next year and or to this year, which have been captured in next year and vice versa. Check always for the cutoff. Now, a quick recap on our accounting understanding. You remember under IAS 17, where we were splitting leases into finance lease and then operating lease. Either way, and now we have IFRS 16 replacing it, superseding it. Now, you realize that we would always have to capitalize the lease assets, where we capture it either as a standalone lease asset, ROU assets, or we include it in the PPE. Okay, that's the first leg. The other leg has to do with the lease liability, which we must pay. So normally you would also find this being split into non-current components of the lease financial liability, and then the current current liability component of the lease financial liability. We have this in hand, okay? Now the IFRS 16, which I said supersedes the current one. Well, some people still use IAS 17 in line with IFRS 16. IFRS 16 is trying to cut off that distinction between operating and then finance lease. Now, under IFRS 16, the lease liability would reflect the initial indexation or rate, that is the retail price index. Retail price index, if you remember your understanding from basic economics, or even without basic economics, it's a measure of inflation, which changes month on month and looks at it changes based on the actual changes in prices of goods and services. Okay, so The IFRS will want to look at this initial indexation. Again, this accounting knowledge. We are not looking deep into this. So, and then we look at linked payments, how we take account of renewal options and break clauses. We are not looking at contingent rents. Okay. Now, the liability, the lease liability and the lease asset will need to be remeasured. Use the indices you have on hand. Okay, check whether you have to use the indexation or an effective interest rate method to calculate this. Now, what we want to say all over here is that if you find the assets to be of similar taste, similar characteristics, apply same auditing measure to them. Okay, so if we have a portfolio of similar leases, apply the same auditing measure. But if the assets are different, they have different flavors, different characteristics, then you have to audit them on lease by lease basis, because the calculation will be based on lease by lease basis and not on the entire pool. Okay, so in this case, a significant degree of judgment is required to ensure that are these all having the same characteristics and fashion and lifestyle. Then let's treat them as one pool of activities or transactions or assets. But if not, we deal with them case on case basis. So like I said, calculation of leases can be complex, and auditors must have a very detailed understanding of how these work. You meet this one and when you start, when you are dealing with advanced financial management. Even with your financial management understanding, you should be able to understand how to discount future cash flows to get a present values, okay? And then use these ones. It's the same understanding we have here. Nothing so complicated. It's just a matter of practice and then understanding the basics, okay? Now, under FRS 102, like I said, we could also use the effective interest rate method, okay, to calculate, to split the lease into each capital repayment component and then the interest repayment component. So, and then we can amortize it over the useful life. Yes, so in which case we can now have a split between the financial assets, lease assets, and then financial liability, lease liability. And then we can allocate the interest component on the lease payments based on the amortized cost that we've had, okay? All right, so I'm just going to financial management and advanced financial management. So that's not what we are going to examine here. But what we are saying here is that, listen, under the EI, effective interest rate method, EIR method, we will amortize the cost of the lease. And this is where we bring in discounting of the future payments to get a present value using the discount rate or the effective interest rate or the annualized yield, whichever you have within the situation. The interest expense in the period would always be equivalent to the carrying amount of the liability at the beginning of the period multiplied by the effective interest rate. So you always have these leases where payments are made in advance or payments are made in arrears. And it's so easy to calculate it. Normally you use an amortization schedule. So you get an opening balance. If payments are made in advance, the opening balance, we take off the lease payment and then we apply the interest rate. We get the net figure and then we carry it forward. If payments are made in arrears, it means you have the initial starting balance, you apply the interest rate, you get the total you owe the lessor, and then you subtract the payment you've made in the year. Now you get a closing balance. It's so easy to calculate these things, okay? So, I mean, you come across it. Now, so that is leases. Make sure the method they are using to calculate, to identify the lease payments are reasonable and they fall in line with the mechanics being employed. Okay, check whether payments are made at the beginning or at the end, and then match up with whatever amortization schedule they have. ISA 540 deals with accounting estimates. Okay, deals with accounting estimates, and it also looks at how the auditor responds to these related disclosures and fair value estimates, fair value accounting estimates. So accounting estimates deals with a lot of subjectivity. Let me put it that way. It is more of judgmental, okay? Here, what we are saying is that we are trying to approximate a monetary value because we don't have a precise means of measuring it. So we are trying to measure it at a fair value where estimation is uncertain and other amounts require estimation. So you want to use the market indicators, market indices and plug them in to ensure that you can get a precise, something approximate. Did I say precise? Something approximate, not precise, because you can't get a precise measurement. Now, here we must always try and obtain sufficient, reliable evidence. It's difficult because we are dealing with judgment. Management are giving us these figures, judgmental. Inherently, it is more risky, like I said, judgmental. Control risk is typically higher because there are non-routine transactions and management is responsible for making these estimates. So it's quite difficult getting this estimate. Now, let's still move on this particular item. There are steps we need to follow when we want to audit estimates, accounting estimates. Because, I mean, in every organization, companies or management would want to use their own approach to derive an estimate. And that's the weakness of some of our accounting standards, which allows us to choose and pick which policy you think is best for your operations. There's beauty in it, but there could be some weaknesses here. But now, under ISA 540 with auditing accounting estimates and fair value estimation, we want to review controls, which management use to identify the estimates. So review the controls, talk to them, ask them. You must also want to test the process which management used to develop the estimates. So which data did they use? Which assumptions did they use? Do they have any reasonable cause for calculating this? So obtain those bases and test, retest them, reperform them. If it becomes so technical, you can use an independent estimate. Auditors will normally have tools and softwares that can generate similar estimates using similar assumptions, okay, best practice assumptions, and compare it with management's estimates. And if the deviation is so significant from your materiality threshold, you want to prove further, or you want to ask them to adjust the estimates. You want to also review prior period estimates and consider the accuracy of previous forecasts. And if some previous forecasts are not too good, you may want to ask for prior period adjustments to be effected on the financial. Again, review subsequent events which confirms that the estimate will occur or has occurred. Because this is not the first time the company is actually providing estimate. They might have done it before in a year or two in the past, if they have done that. So, and the question is, did they really materialize? If it did materialize, check the actual to what was forecasted in the past. And if it makes sense, I mean, proceed on similar grounds, okay? I remember I was working with one of the audit firms, went to audit Babcock University in Nigeria, and I worked with this senior colleague, senior person from the US. And we were trying to look at some of the estimates which were done. We couldn't get it, so we had to use market indices. We worked with Citibank indices because the figures we're dealing with has to do with financial instruments, and we have to look at them. Citibank, which has similar one, and try to work out the differences. And when we realized there were significant changes or deviations, we asked them to adjust, to pass adjustment. Where it is reasonable, we leave it. We leave it. Okay. All right. Provisions. This will also fall under IAS 37 provisions, contingent liabilities, and contingent assets. You know what provisions are? We make provisions for legal claims, restoration of environment cleanup, repairs, maintenance, warranty work. We always have to make these provisions for that. So it is a best estimate where we take account of all known factors, including the risk of insurance, okay, or insurance of risk. Now, we have to follow logic and calculations, which management has provided us. And if possible, we must reperform these calculations independently and compare with what the client has provided for. Now, note that it is not just an intention to pay, but there must be an obligation to pay before a provision would have to be recognized. Under contingent liabilities definition, we are looking at possible obligation arising from past events, which will materialize or crystallize dependent on the outcome of future uncertain events. Now, present obligations, where the resources required to meet it cannot be determined with certainty. So we make provisions for that. You want to make provisions when there are legal cases hanging on your neck. Can you determine the outcome with certainty? No, you cannot. Okay. And it may have arisen from past events. Maybe a work person, somebody at the workplace gets seriously injured or die in the course of discharging his work. And this could mean some significant burden of financial cost to the company, because at the end of the day, it will crystallize. But we are not too sure what will happen, how the future will determine it. The legal processes will tell us. It tells us that, yes, under contingent liabilities, when we are auditing, we need to work with the legal machinery very closely. Examples of contingent liabilities include discounted bills, guarantees to third parties, damages in legal claims. I was just mentioning that, forward contracts, warranty or guarantee claims. So you once again need to have a deeper understanding of how financial instruments work. You are seeing forward contracts here, swaps, options, futures. Okay, you want to see all of these and how they are standardized, how they work in the real world of financial management. So these are examples of some of these. Now, like I mentioned, under IAS 37, you find these items, and here, provisions, contingent liabilities. I'll cut off the contingent assets. They disclose the nature of the liability on certain facts which affect the outcome of the liability, and an estimate of financial effect. These are what it discloses, and these are what we need to always audit check: the nature of the liability. What are those facts which are uncertain that would affect the outcome? And what estimate financial effect can we have on the accounts? Now, contingent liability, sources of evidence we need to obtain as we audit. Management inquiries and representations quite important, because they are in charge. They can hide things, and you need to be a god to determine this. Auditors are dealing with reasonable assurance, not absolute assurance, so it can be quite tough, Obtain the board minutes and other meetings. Any key committees who have had meetings, obtain those minutes and review them. Correspondence with lawyers is very important, because here you may have legal issues pending on the neck of the company. Obtain the legal expense account and vouch it, and look at what goes into this legal expense account. We must also obtain permission from the client to have direct communication with their lawyers. And then look at the client system on how they record claims. Okay, sometimes you go to the client's office and you see they have a dashboard in their open spaces where they show how they've complied with staff security and staff safety. And you might always see people injured in the line of work. Obtain those analysis, speak to the one in charge, and ask whether there are any costs associated with these workplace injuries and how they have been resolved. Okay. Contingent liabilities, you might also want to assess the basis of calculation. How are they putting this in the accounts? Consider expert assistance if you have no knowledge about that area. And mostly you will see, like I said, senior auditors, the in-charges, the managers, normally taking their time to work on this, because this is where frauds occur, and you need an expert or someone who is seasoned enough to be able to bring out evidence from these aspects. Consider the need for any additional provisions where necessary, and make sure all disclosure requirements under IAS 37 are met and fully disclosed in the books of the client. Okay. Last one, and then we end. So take these provisions and contingencies flowchart and use it as a guide. Okay. Now, does the entity have a present obligation as a result of past events? If yes, you ask yourself, is there a probable chance that economic outflows, outflow of economic benefits would occur? And here we're looking at probability chance of more than 50%. If yes, there is a higher chance over more than 50% that economic outflows will flow. Ask yourself, can the amount be measured reliably? If yes, they can be measured reliably, provide for it, make provision for it. Make provision for it. Okay. Now, does the entity have a present obligation as a result of past events? If no, then ask yourself, is there a possible obligation to transfer economic benefits? If yes, there is the obligation to transfer economic benefits, ask yourself, is this possibility remote? If yes, it is remote, do nothing. If it is remote, do nothing. Okay. Now, but if the remoteness is not, is the possibility that it is remote it's not there, then you must disclose it fully. Okay, you must disclose it fully. Once again, let's start. So does entity have a present obligation as a result of past event? Yes, we've dealt with all the yes. If no, ask, is there a possibility that they will transfer economic benefit? If yes, is it remote? If no, disclose it. But if the remoteness is yes, do nothing. Once again, do nothing. Would there be a possibility to transfer economic benefits? No. If no, do nothing. Okay. Once again, is there a chance that the economic benefit which will flow from the company is more than 50%? If no, once again, ask yourself, is it remote? Is the possibility remote? If yes, do nothing. If no, disclose it. If we cannot measure the amount of the economic outflow reliably and what we have identified, if we cannot, disclose it. If we can, provide for it. Okay, all right. So this is a flow chart which would always help us, and these are questions we could always look at for ACCA style exam questions on page 285 on the fast food is always important for us to look at. Now look at it, friends. I want to just end here, but once I end, I want to give these closing remarks. You realize that most of the examination questions are ACCA style. In fact, if you take Millichamp and Taylor's books, sometimes when they try to craft their own question, they will write it, the question in an ACCA style. You know what I'm telling you is that your exams will be in an ACCA style question. So if there are any ACCA questions, the recommended textbook, you have an exam kit, read it. Read it. Both Millichamp and Taylor agree that their exams take the style of the ACCA approach. An ACCA text which we are using is very important. It's one of the recommended texts for this module. So you most likely find your question in the form of an ACCA style. I hope I'm communicating to you. All the best. I'll see you when I see you. Bye for now.